Coming to you from the campus of Kansas State University, this is Agriculture Today. Thanks for listening in on this Friday. Well, the USDA on Wednesday provided what could fairly be called a stem winder of a report on the crop acreage and on grain stocks as well. The markets certainly reacted to the new numbers, and we'll talk about that and other grain market factors now with Research and Extension grain market economist Research and Extension grain market economist Dan O'Brien from his office in Colby, Northwest Kansas. So, Dan, the corn and soybean numbers, planted acres, as the USDA saw them, fell quite short of expectations, and that set the market afire for a short time anyway.
When you look at the closes on the day that report was released, which would have been Wednesday the 30th, we had, of course, the July contract's the lead contract, and as of the day, as of now, it's in the delivery period, but it was just on the verge of or starting to do that. So it went up 25 cents a bushel. Then you had lock limit up 40 cents a bushel for the September 21 through May 22 contracts. So tremendous rally in the corn market on the future side. And then for soybeans, hanging around 90 and a quarter up for July, August, September in the 80s, 83, 86 cent rise range from in the November and January timeframes, and then 60 and 70 from there. Even wheat got into the act, probably pulled up some by what was happening in the other two crops, especially for corn, up 31, 32 cents on that day. And since that day, when we look at the day after closes, there was some follow through. Whereas the September contract closed at 5.99 and a quarter. We didn't end up and lose a whole bunch that next day. We basically closed at 6.01 and three quarters. So there was enough there that people didn't have regret and just bail out on the next day. And the close on soybeans, again, 14.30 for the August contract, now the lead that prices are based off of. We end up and close at just essentially the same number on the day after. For wheat, interesting, we did jump up on wheat on September to 6.79 and a half, and then have lost some in the day after, down to about 20 cents. But you know what, the way I look at this type of volatility, you and I have talked about this, and that at these lofty price levels, if you look at the percentage change, that 5%, a 5% change is at $4 wheat, as opposed to what a 5% change is at 6.38. Well, you start to get a perspective and picture on that. Right now, what's 5 cents? You know, that's just noise in the market. Whereas here we dropped 20 cents, and gosh, harvest pressures and all that, we're still hanging around 6.38. It is noteworthy to me that really hard to find any carrying charges in the corn complex or soybean complex, but here in the wheat complex, we have storage type charges running from the September through December, March and May contracts. Well, at least through March, 3 to 3.5, 3.75 cents. So I'm not quite sure what that's saying, other than we have a new crop that's come in, and the market's recognizing that there's some need for a storage impetus or storage function to go on. So that's probably the result of the harvest being here. I would say too that as we've tried to watch what's happened in the cash markets to go along with those futures, that when you look at the cash prices for again Colby, Salina, Topeka, Garden City, Hutchinson, and Columbus, and look at the very top bids, and sometimes those top bids can be deceptive, because as I've looked at, for instance, in the major train rail markets, say Topeka, Hutchinson, and in particular, you'll see one or two bids, and maybe Salina, really standing out, X number of cents above others. And that's what we have here, but you'll see the bulk of a lot of other bids 20, 30 cents below that. So somebody's filling a train or has some type of contractual arrangement they're trying to get. But all that said, let me just read across the spot prices right now for corn and sorghum. So in Colby, corn price 705, sorghum price 695. Salina 662 for corn, 678 for sorghum. So a little hotter use of sorghum in an export market. Topeka 695 corn, 675 sorghum. Garden City 677 corn, 652 sorghum. Hutchinson 720 corn, 740 sorghum. Again, you'd expect that that's looking towards an export situation. And Columbus 763 corn, 780 grain sorghum. So I don't know if that's export so much, only as much as you'd call export from southeast Kansas down into the livestock areas, the feeding areas to the southeast of that. So one thing that's noticeable there is that the Southwest Kansas market, which in most cases top, with all the demand down there, really leading the state. Well, in this case, it's just among the pack with other areas. Well, 4 out of the 5 other areas having higher prices at these moments. So, and that's happening in the midst of wheat harvest going on down there. So I don't have a model to say exactly what's going on, but when you wonder why the Southwest Kansas market might be a little bit softer for the feed grains than it had been, to me, the only thing that's changed is that we now have wheat to deal with, and maybe that's taking some of the extreme tightness of grain supplies away from some of the feeding. I want to add in too. So we're looking at harvest and what's all happened there. The outside factor that's come in and affected markets this week has been the ongoing frost risk and tangible reductions in frost risk in Brazil. And we remember they planted that crop late. They thought, well, it'll be no problem, we'll get through it, etc. The soybean harvest was late, that delayed everything. And for planting their second crop corn, they got that thing in again later, and now they've had ongoing frost damage to that crop. So all these are setting up for strong support for the feed grain markets. And I'll just throw one other thing in, Eric. I'm just kind of on a roll here this morning, but you look at the weather map of the United States. You're running from and we have that in our supporting information. You see a band for 7-day accumulated rainfall running basically from New Mexico, Texas Panhandle, Oklahoma, including parts of Kansas, but running from there up into Wisconsin. And it's very wet, big rains, but you see dryness on both sides of that, in the southeast and to the out of all that, still dry in good parts of Iowa, Minnesota, North Dakota, South Dakota, and of course really rough off in the Pacific Northwest. So when you look at I think the situation that we're in, if I can describe it, so now we've got that quarterly grain stocks report that said that we had lower than expected corn stocks and lower than expected, a little bit lower than expected soybean stocks, even a little bit lower than expected wheat. So we saw that we've got tighter stocks, which means we had a little better usage, probably feed usage than we had expected. And so you combine that and you bring that into the upcoming July WASDE report, probably going to tighten, probably expand usage some, at least for the feed side. And then, so that's on the old crop usage side. That in itself would tighten up ending stocks and ending stocks this marketing year, beginning stocks for the next. And then you add on top of that that the USDA numbers for the projected planted acres for corn, 92.7 million acres. below 93.8. Well, basically 1.1 and change million acres less than that. And you got dryness in different parts, moisture, if not excess moisture in others. And it just, I think it just puts laser focus on for the corn market on what that yield is going to be. So is that 179.5 bushels per acre that USDA projected early on as kind of a placeholder saying, hey, we needed that to basically balance the balance sheet. How now we thought, well, that is kind of what it is. We'll see how it works out. Now we don't have such tightness that we damage the usage industries. We'd be hoping we'd get that. And you got this streak through the middle where it looks, yeah, that'd be great. If the whole country was that, we wouldn't have the corn market we have now. But all these problems to the northwest and southeast of that string, that's a deal. And I would say if the southeast is catching dry weather, then that prolongs that if that damages their crop, the early harvested crop, then that gives us strength through the summer months that much more, because that crop isn't coming to the rescue as readily as it would normally expect. So for corn, we've got it's quite the challenging situation. And I was thinking, we look back on the memorable years that we have, the 1988s, the 2012s, the 1993s, as I remember it. Some of those are floods, some of those are droughts. Um, but this is a year like that. It's that much uncertainty, and we'll see where we end up.
No doubt we'll have weather markets galore here as we move forward. Just one quick thing here, Dan. We just, again, don't see signals of serious weakening of wheat prices whatsoever as harvest is pushing into, well, the latter half, at least here in the state of Kansas. Producers, being perhaps skeptics, have to wonder, will the other shoe fall at some point? It just doesn't seem like that's in the cards when one reads the tea leaves, if you will, on stocks and so forth.
I think the situation up in the hard red spring wheat country is affecting the overall wheat balance sheet, and they're dry as all get out. Our former colleague Bill Tierney has been with an independent company, has been reporting diligently on how damaging dry conditions are up in Canada. So the same spring wheat production area geographically, it extends from parts of South Dakota, particularly North Dakota, over into Montana, where white wheat's getting involved, and going up into Canada. Tough dry conditions up in those areas, and it'll make for where it's a little drier, perhaps decent proteins, but boy, the quantities sure look to be damaged, and that. So where does the wheat industry look for flour? Well, it looks down to here to try to find whatever it can that it will have a decent quality to it, and so probably wheat I have not heard of what the wheat protein market is doing. Boy, there's sure a lot of anticipation that with our large crop, with the moisture we've had, that boy, if anybody has protein, this has wheat of good protein, that could be a valuable commodity this go around.
And as a final item here, you tell us that you're just about to crank out your next round of price probability projections, given all of this new information, right?
Next week when we talk, we'll have plan to have taken this information for corn, for soybeans, for sorghum, and for wheat, and have really scoured through the details and to see where we stand. Won't be a lot of surprise for people because our acreage numbers are tighter. And by the way, these acreage figures, we ended up with the lower figure for sorghum in Kansas and in the U.S. We're still above last year, but we're lower. We were lower in the June acreage report, than we were in the March prospective plantings report, and that deserves some scrutiny as well. And what happened, and the explanation lies, well, with what farmers could do with planters on the one hand, battling wet conditions in some cases, and in the relative prices that they had to consider versus other crops, particularly corn. So challenging situations for anybody. Still, these are wonderful prices without question. It's just a matter of where they go, and what the rest of the summer holds for us.
Looking forward to seeing and hearing about your price probability and scenarios as they might shape up here. And we'll get into those next week when we touch base once more. Dan, thanks as always. Appreciate your time.
Thank you, Eric. Take care.
His weekly grain market analysis and comment. Dan O'Brien is a grain market economist with K-State Research and Extension. Check out his weekly notes on the trades at agmanager.info. And we'll be back in a moment on Agriculture Today.